hope everyone is doing well. So over the past 2 weeks, the situation in the Middle East has escalated significantly, as you're probably aware. This escalation has driven oil prices higher to levels we haven't seen in a long time. And the market hates this uncertainty. And here's why. As many of you probably know, oil matters a lot. It's embedded in the cost of everything. It takes oil to manufacture goods and oil to transport them. So when oil spikes, the price of virtually everything comes into question. And the market has to price assets accordingly. That uncertainty is what creates the volatility. On top of that, the interest rate cuts many people were expecting from the new Fed chair may now be on hold. Lower oil prices were helping bring inflation down, which was clearing the path for the Fed to cut rates. But sustained high oil reverses that dynamic. If oil stays elevated, inflation stays elevated, and the Fed won't cut rates. Higher interest rates for longer is a headwind for stocks across the board. My positioning in our accounts reflects this reality. I've been selling portions of our equity positions over the past week, 2 weeks really, to raise cash and protect principal. I'm decreasing position sizes and increasing our cash allocation so we have less drawdown and we have more dry powder to deploy when the market finally hits bottom, because that's when you really make money. Our income investments and our notes, our dividend-paying positions, will continue generating returns during this period, which provides stability. On metals, I remain as confident as ever. We see another bottom maybe in the next week or 2 or 3, but our larger metal position should help us quite a bit as the year moves forward and the metals rebound. Here's the reality. You can't go from 100% cash when your account's at the highest. And sell to cash. That's foolhardy. You know, we saw in August, as an example of 2024, the market corrected almost 7% overnight. And then within 2 weeks, we rallied that 7% back and we're up 12. So then you're chasing it back up. It's not a great idea because you never know when it's going to turn. And we saw it again in March of last year with the tariffs when the market moved down and up so quickly. And if you're sitting again completely in cash, you miss those moves entirely. The market moves fast and these situations can resolve quickly. But you also can't stay fully invested and take the full drawdown when there are real economic headwinds like we're facing now with oil. So we're watching it constantly, actively manage, and selling when we need to raise cash and protect principal. But we're staying positioned to redeploy when the opportunities present themselves. We're prepared to continue to sell things if it continues to deteriorate further. We're monitoring what sectors are rotating, and right now most sectors are under pressure because the market doesn't know what to favor. But energy and oil, and now the metals, that we're still invested in haven't sold a whole lot, and they continue to perform. We're even looking to add more in those areas. Defense is another sector that may begin to outperform if this conflict is prolonged, and we'll look to add there. Defense. While we're seeing a temporary 10-day reprieve in these headlines that we're not going to shoot anybody or whatever it might be, the underlying price of oil tells a different story. It stays elevated and is going higher. That is why we're leaning into the energy and defense focus. We aren't guessing on the headlines. We are following the capital flow. If the conflict de-escalates by April 6th, which is the date that is the deadline, we have cash ready to pivot back into growth. And if it doesn't, our energy, defense, and metals floor remains there for us. That's a disciplined methodology behind what we're doing. Thank you for listening. Have a great day. And if you have any questions, give me a call, send me an email, send me a text. Thank you. Have a good weekend.